Pat Soldano. I'm president of Family Enterprise USA, as well as Policy and Taxation Group. Family Enterprise USA is an organization that promotes family businesses and their job growth in the United States. We are very pleased to have with us today one of the sponsors of Family Enterprise USA, and that is Pathstone. The topic that we're going to talk about today is very interesting. Before I discuss that, I want to make sure you all know that this call is being recorded, and you are not on video nor are you on audio. So in order to ask questions, you're going to need to put a question in the chat or the Q&A, which I will attempt to manage. So please do that. You can do that as we go along through this webinar. So today, I think this topic is very interesting, and I think there's very few people or organizations that really understand it, like Pathstone and specifically Allan Zachariah. So the topic is for-profit family office, and is that right for you and your family? So there is this gray line between family office and family businesses, and there are some unnecessary risks. So you really need to think about if you've lost deductibility for meaningful investment-related expenses due to this 2018 Tax Act that you all recall. A for-profit family office might be the best answer for you to create opportunity for operational efficiencies, privacy, and to reduce tax liability, which we all know is very important. So what we're going to learn today in this webinar is what is a for-profit family office, the risks and the opportunities of a for-profit family office, and the key benefits and considerations. And as I mentioned, I think this is a unique topic in the family office world. And I think that Pathstone is one of those organizations that has created this for-profit model. And Allan Zachariah, in my opinion, is the clear expert. So to give you a quick background, Allan is the co-founder of Pathstone, the modern family office. He serves families, family offices, endowments, and foundations. He's currently the co-chair since June of 2022. He serves also on the executive leadership team, and he has 41 years experience of serving families, professional, high net worth individuals, and families of significant wealth with sophisticated wealth transfer strategies and solutions. And he also is a frequent speaker on this very topic. So, Allan, I'm going to turn it over to you. I think we're all very interested in what you have to say today.
Thank you, Pat. And it's a real pleasure to be here. Pathstone is thrilled to be a sponsor of the organization and the important work that you're doing, that you all do and continue to do. In our time together today, I hope to impart a little wisdom about one of my favorite topics, which is what we've dubbed the for-profit family office. I'd like to introduce myself as a recovering tax accountant. I spent the first 20 years of my career in public accounting and left public accounting 22 years ago to get into the business that we called at the time integrated wealth management. We didn't really call it a family office 22 years ago. And then we called it a multifamily office. We formed Pathstone a little over 12 years ago. We are some 300 professionals today in over 14 offices, serving families all across the country in our integrated model, and a few across the world as well. So really thrilled to be here. I am going to share my screen. I'm also, I would like to say that this webinar format of a talking head is not as pleasing sometimes as being together and being interactive. So I really would encourage those of you who are on the webinar who we can't see or hear to please make this interactive if you'd like to. I certainly encourage questions as we go along, and we'll leave some time at the end for Q&A, but it makes for a more interactive and candidly fun session for me if we get questions as we go along. So I'm going to share my screen, Pat.
Okay. And while you're doing that, I know we have one question from Steve Singer, but Steve, I'm going to wait because of that question you're asking in the Q&A. Let Allan get started, and I'm going to wait and we can ask that one at the end, please.
hang on one second. Let's try this one more time. Of course,
You had it.
I did. Okay, there we go.
Uh-huh.
Okay, so
There you are.
we're going to talk about the for-profit family office structure today, and it's something that I've been helping families and clients with for over 20 years. We're going to talk a little bit about types of family offices, do a quick definition overview. I'll run through the benefits and some key considerations. We'll then I'll go through kind of a traditional structure of it. We'll talk about a seminal tax court case that came out. Pat mentioned the 2017 Tax Act. The 2017 Tax Act was passed on December 22nd of 2017, effective January 1st of 2018. But there was a seminal tax court case called Lender Management versus Commissioner that the ruling came out actually on December 13th of that same month. It was those two events happening at the same time or in the same month is pretty interesting, and we'll talk about that. So first, I think when we start, before we talk about the for-profit family office, I think it's helpful to talk about the different types of family offices and why have a family office at all. I know generally this group, this audience, are family enterprises, family businesses, and you're most obviously in operating companies. Some of you, I'm sure, multi-generational, if not many generations. But what we see in a lot of operating companies, especially operating family businesses, closely held businesses, especially ones that have been around for several generations, is the businesses have been very successful. And there's a lot of liquidity and a lot of excess wealth that's created that's not necessarily needed to plow back into the business and gets distributed or creates excess capital of liquidity. And even operating closely held businesses will often form a family office for the family. And typically we talk about that type of family office being an embedded family office. The family office is actually embedded in the operations of the operating company. We talk, most folks know about an SFO, a single family office. Most of the single family offices that were created in the US are created, from businesses that were created post World War II. The business has been sold at some point in the past, and a very large amount of liquidity was created for the family. And the family will often create a single family office to manage that liquidity, similarly for the benefit of the entire family, the way the operating company was there to benefit the entire family. And most of the time, that's a cost sharing relationship. It's really an expense, and oftentimes it's just, and maybe 2 or 3 families will come together and share a single family office, again, sharing the expense of the staff and the real estate and the technology and everything that it takes to run a single family office. The smaller families, oftentimes, who want a family office but don't want to go to the expense or the complication of setting up a separate entity, real estate, staffing, etc., will outsource a family office to an organization like ours or others, and we typically call that a virtual family office. And lastly, the type of family office we're going to talk about today is really when a single family office wants to be in business for profit, and that is an SFO, or what we call a for-profit family office. So many benefits of setting up a family office, as we list here: consolidating affairs of the office, certainly providing an opportunity for wealth management structuring. It can create a great opportunity for investing in a very efficient manner. And it can also create a comprehensive and coordinated approach to philanthropic activities of the family, as well as tax preparation and other activities. A for-profit family office is really structured very much like a private equity firm or a hedge fund. Typically, the family office will set itself up and it will be organized to manage pools of capital from the investors in this case being family members. They do that in exchange typically for a combination of a management fee and a carried interest or a profits interest. Carried interest is a big topic, has been a big topic for many years. Something that we can talk about. There may be some questions around that, but it is really the ability to manage pools of capital, very similar to a private equity firm or a hedge fund, that will create the income from the family office. We typically, all of the expenses of managing those pools of capital, and I'll talk a little bit about the economic bargain that is struck between the investors / family members or clients of the family office and the family office. It's the same economic bargain that any investor makes when they go hire a private equity firm to manage private equity investments or a hedge fund to run a particular hedge fund structure. And that economic bargain is that I will invest with you, the manager, and you will take care of all the administration, the taxes, the accounting of my investments. And if the investments perform well, you're going to earn a profits interest or a carried interest above and beyond maybe a small management fee. The family office takes on all of the responsibility and all of the expenses of the operation, and so accounting fees, tax return preparation fees, third-party investment advisory fees, and it's important and seminally important for a for-profit family office to be able to hold itself out as a profit-seeking, profit-oriented organization. Some of the benefits of any family office, but certainly a for-profit family office, is the ability to coordinate investments amongst generations who have different risk profiles and investment goals. I'll talk a little bit about lender management later in the talk, and how Marvin Lender, when he created the lender management structure, he wasn't doing it for tax purposes. He really wanted to do it because all of the family's investments were in one large investment partnership. And that included about 27 different entities and trusts and individuals. And Marvin, back when he set up this for-profit family office structure in the 2005, 2006 timeframe, the real reason that he did it was because he couldn't understand why his asset allocation was the same as his grandchildren's trusts. It didn't make a lot of sense to him. So he went looking for a structure that could be managed by the family office, but with different risk pools of capital, which we'll talk about. Certainly the tax benefit, the for-profit family office structure doesn't create a tax deduction where you wouldn't otherwise get one. What it creates is less income allocated to the investors because there's income that's allocated away from the investors through the carry or profits interest to the family office. And we'll talk more about that a little bit later. Then the economics, the ability to cost share amongst generations. And then, when we pool capital into large pools, we have the opportunity to make investments that we might otherwise not make as individual investors. Lastly, when we pool capital into investment partnerships, we have the ability to use those investment partnerships for wealth transfer planning as well as the for-profit family office structure. Pat, do we have any questions at this point that have come up that we want to address at this point?
We have a question from Steve Singer. I don't know that it's going to fit where you are right now, but the question, you can address it now or later, is how do you handle the personal holding company issue?
That is a pretty technical question. And I did not have the PHC issue in the materials, but we'll talk about it when we get to the structure. Okay. Basically, the quick answer is just Steve was the person who asked the question.
Yes.
The quick answer is that oftentimes the management company, the for-profit family office, will be a personal holding company. But when you work through the personal holding, the calculation to determine, to figure out if you owe any personal holding company tax, 98% of the time, there will be no PHC tax. And it's a little beyond the scope here, but we'll talk about that a little bit later. Thank you. So key considerations in a for-profit family office. As I said earlier, very important that it's deemed to be for-profit. And how much activity is there in the office? The type of structure, the entity type is something very important that we'll talk about. Designing the carry and how the family office gets compensated is very important. I'm going to talk about the difference between Internal Revenue Code Section 212, which are expenses incurred for the production of income, which right now are not deductible under current. They were typically miscellaneous itemized deductions, and they were allowable unless a taxpayer was in the alternative minimum tax. If the taxpayer was in the alternative minimum tax, they got no benefit for that. In the Tax Act, which the Trump administration, the promised Christmas gift in December of 2017, there were many positive aspects of that Tax Act, the Jobs Tax Act. One that I know this group was very keen on, which was the doubling of the estate tax exemption, which none of us really expected. But I like to say there were a few lumps of coal in that Tax Act, which came at Christmas time. And one of those lumps of coal was no longer were we allowed to deduct miscellaneous itemized deductions for the next 8 years. Included in miscellaneous itemized deductions were investment related expenses, Section 212. So if in a investment partnership that pays a management fee to its management company, that type of expense would typically be a 212 expense passed through to the investors on a Form K-1, which they wouldn't be able to deduct. So it's very important when we design a carried interest, a profits interest, that it gets respected as a profits interest. So that is one of the main key considerations of a for-profit family office. In designing the carry, there has to be real economic substance. The family office cannot be guaranteed that it's going to earn a carry or profits interest. If it is guaranteed, if there is no economic risk that it won't happen, then the IRS will deem that, even if you might call it a carry, you might call it a profits interest, but if there's really no economic risk, upon review, the IRS would recharacterize that as a fee. In 2015, there were some proposed regs called the disguised fee regulations that were proposed by the government, the IRS. Most of us who practice in this arena don't think those disguised fee regulations will ever see the light of day as final regulations. However, it was pretty indicative of how the government was viewing it. And there were 6 factors, but the two most important factors were this concept of true economic risk, and there could not be a cap. There had to be an unlimited upside on the carry. And when we work with clients, and by the way, I'm not a lawyer, I'm a tax accountant by training, much to my grandmother's chagrin. I didn't become a lawyer, and we work closely with law firms in designing these partnership operating agreements to design these carries. But it is very important that we have unlimited upside. Another major consideration in the for-profit family office structure is ownership of the office versus ownership of the assets. If the ownership of the family office mirrors the ownership of the investments, upon review, the government will likely make what is known as a Higgins argument. And what is Higgins? Well, Higgins is a court case that went all the way to the Supreme Court, decided in 1941. Mr. Higgins was a successful business person. He ran a real estate operating and development company out of his New York office as well as running all of his personal investments out of that office. And he deducted all of his expenses for his real estate activities, as well as his investment and portfolio management activities as ordinary necessary business expenses. Upon audit, the government said, your real estate expenses are okay. That's an operating company. We think that's a trade or business. But the management of your personal investments, all of that is non-deductible. There was no 212 back in the 40s. It just wasn't an allowable deduction. And so in the Higgins case, again, which was went all the way up and held at the Supreme Court, Mr. Higgins lost his argument. And he was very wealthy, and he had created a lot of complexity in managing his personal investments. But the holding in that case continues to basically be the law today, which is no matter how wealthy you are, no matter the magnitude of your wealth, and no matter how complicated you make the management of your wealth, if it's just you managing your own wealth, it can never rise to the level of a trade or business. It's always going to be considered personal in nature. So if in structuring or in looking at a family office structure, if it is just the family managing, in the lender management case, which I'll talk about a little bit later, that is exactly the argument that the IRS made, which was the lender family was just managing its own money, and therefore the expenses were not ordinary and necessary business expenses under Code Section 162. They were 212. That was the government's argument. They made a Higgins argument. And so it's really important when structuring these that we make that the family office and the ownership of the office is divergent from the ownership of the assets. And then generally speaking, and again, I'm not a lawyer and certainly not a securities lawyer, but typically an investment management company that manages investments in pools of capital for others is required to register with the SEC. There is a family office exemption that basically says if all of the investors and key employees are from one family tree, you can be exempt from registration. So when we look at the customer base, the investors, when we're setting up a for-profit family office structure, we want to be very keen on this issue because it's our experience. It's and we've probably worked on some 35 of these over the last decade, if not more. That it's our experience that most families do not want to go through the burden of registering, and so they really want to qualify for the family office exemption. I do have a few exceptions to that rule, but that's generally the case.
So Allan, we have a question from Lorna. Again, I think you can answer it now, or it may fit in later. And I think it's a really good question because I think a lot of families struggle with this. How do you deal with multiple real estate LLCs where the family members' trusts hold different percentages of interest in each LLC? Currently, we just make quarterly distributions to each trust based upon ownership percentages of the trust from net income after operating expenses are paid. So I think the question there is, they have real estate LLCs, and they're trying to figure out how to do these distributions.
Well, that's an interesting question, and I mean, I'm happy to address it. I guess in the context of what I'm talking about today, which is, and can you can see my screen, Pat? You can see the model structure I have up.
Yes.
Okay, great. So it's pretty typical for a family that has multiple real estate LLCs that they would have a structure that looks something like this. And if we're setting up or organizing a for-profit family office structure, it's oftentimes that the family office will also manage those real estate LLCs. And again, do it for typically a small management fee, and the majority of its income would come through a carried or profits interest. Around this issue of distributions, I'm not sure if the question, I mean, certainly there's a requirement that distributions, usually the partnership agreement or the LLC operating agreement will typically address how profit distributions of profit are to be made. They're typically done based on capital accounts ownership percentage on a pro rata basis. The question, the question may be, or the questioner may be asking, what if we don't want to do pro rata? What if someone wants to redeem a part of their interest? And typically what we will do in our partnership agreements or LLC operating agreements is provide very similar to a hedge fund for, not necessarily monthly, but quarterly, semi-annual, or annual opportunities for a redemption with a proper notice. Now, in a real estate portfolio, illiquid portfolios, that it may be a longer notice period, but anything beyond pro rata typically is done as a redemption, and which usually is done on a, like I said, quarterly, semi-annual, annual basis. Okay. I hope that answers the person's question. So what I've put up on the screen here is really what I call, or what we call, the model for-profit family office structure. And what we have here at the top is the family office, and I say LLC/C Corp. And I think that I'll stop there and just talk a little bit about entity structure of the family office. When we first, well, if you go back many, many years ago before the LLC, most family offices were structured as C Corps. The LLC came into being 20 plus years ago, and it really became the entity of choice. As we have dealt with for-profit family offices, and back to the issue of ownership structure and concern, or wanting to make sure that the ownership of the office and the ownership of the investments was divergent, there's been over the last 5+ years, a real push towards most family offices being C corporations, not the least of which is the reduction in C Corp income tax rate to 21%. So oftentimes we see the family office structured as a C corporation these days. The family office then makes this economic bargain with its clients. And here in this example, we show on the left-hand side, the clients being, basically family members, individuals of a family tree. And again, this can be a family tree from a founder, could be 3-4 generations deep. So you can have quite a few clients or customers, family members, but you also typically find as clients of the structure, all of the multi-generational trusts that the family has organized. The bargain that the family office makes with the clients, I mentioned this economic bargain earlier, is invest with me, the office, invest with us in pools of capital. And typically, I'm showing here 3 distinct pools of capital, but they're different risk pools. And so let's just focus on the left-hand side. Let's just say that we, invest with me in a large cap US stock portfolio. And the bargain that we're going to make is you're going to invest in this partnership. You're going to be a limited partner. I'm going to manage the investments, either myself or with others, and use third-party advisors as well. And I, the family office, I'm going to be responsible for all of the expenses, both direct and indirect, that are needed to be incurred to manage that pool of capital. And what could those expenses be? Well, the expenses that I'm responsible for, again, accounting, administration, legal, taxes. And to the extent that I want to bring in a third-party advisor to act as a co-CIO, chief investment officer, could be investment-related expenses as well. Those are direct expenses. What are indirect expenses? If I, in managing this pool of capital for you, investor, decide that I have a good opportunity to have good performance by investing that capital downstream into a lower tiered partnership with another, basically creating almost a fund of fund structure, then that lower tiered entity, which you don't see on this structure, I don't have any lower tiered entities, but that lower tiered entity is also going to have expenses. In my wisdom as the manager of the investments, if I made the decision to use a lower tiered entity, then I'm also responsible for all of those expenses. Those are indirect expenses. And we'll talk a bit about how you recover those indirect expenses. The direct expenses are easy. The family office contracts for all those direct expenses. So the bargain is invest with me, I incur all the expenses. I might charge you a small management fee when the securities, the investments, whatever type of investments are in this partnership do well, then you're going to pay me a carried interest based on our bargain. And that carried interest, that profits interest, will be the first slice of income that gets allocated from that pool of capital to the family office. So in this case, you see I've shown 3 pools of capital. I've also shown another group of clients because many families, and I'm sure many of the folks who are on this webinar today have family foundations, private family foundations. The family foundation can also be a customer, a client of the family office. And we typically do that for a straight management fee because that, as I'm sure most folks know, the private family foundation, the family foundation is required to basically spend or distribute 5% of the fair market value of its assets on an annual basis. Well, a management fee paid to a third party, and even though there may be a relation here between the family office, an arm's length structure between a private family foundation and the family office is certainly allowable, and we can do that for a straight fee. We then, and so we'll have multiple pools of capital based on risk. I was working with a family in St. Louis a couple of years ago, and we were talking, I had this same diagram up, and we were talking about how many pools of capital would be appropriate for this family. And their position was, well, we think there are 12 distinct asset classes, so we'd like to have 12 partnerships. I thought that was a bit too many, candidly, but in any event, that's the point of this, is that each of these pools of capital will have a different risk profile. And so here, by way of example, for this model structure, I show a marketable securities partnership, which can be cash and equities, could be fixed income. Oftentimes, those asset classes will get split up between equities and fixed income. Equities being a more high risk profile, the fixed income or fixed income like investments being a lower risk profile. Oftentimes, we'll have a separate pool of capital for hedge funds and alternative investments. We might, as the question came up earlier, we might have a separate pool of capital for real estate or multiple real estate. And then typically we'll have a separate pool of capital for private equity investing, here showing that a typical vintage year investing where we're, every year we're buying some amount of private equity and building out a complete private equity portfolio. One of the great benefits of this structure is if a family that, let's say a family that has $100 million to invest, $200 million, and they're excited to go invest with a new manager. And let's just say they're going to allocate $10 million to that manager. When in a typical structure where you don't have a family office, and you're looking over here to the left of the multi-generational individuals and trusts, the family often says, oh, we want to fill out a $10 million allocation. We'll take 500,000 from this trust, 500,000 from that trust, $1 million from this individual, $1 million from that individual. And before you know it, it takes 6 or 7 or 8 different investors to fill up the $10 million investment pool. And what does that create? That creates 10, 8 or 10 different sets of fund documents, subscription documents. Every time there's a capital call, there's 8 or 10 different capital calls to keep track of. When there's distributions, we got to track down 8 or 10 different distributions. There's 8 or 10 different K1s that come out for tax return purposes. One of the beauties and the economic efficiency, not tax efficiency, of this structure is that when in this structure, if the family wants to make an investment with a manager and allocate $10 million, we just figure out which risk pool it goes in. And then it's that risk pool that makes the $10 million investment. The other beauty of this structure, I like to call this structure the win-win-win structure, is all of these individuals that own various percentages, we asset allocate amongst the generations by how much they own of each of the risk pools. So, someone in the senior generation, later in life, who has a lower risk profile will typically own more of the pools of capital, excuse me. Will typically own more of the pools of capital of the lower risk partnerships. And again, back to what I talked about with Marvin Linder, grandchildren and great-grandchildren trusts where they may not even need to touch those assets for 20 plus years, they can take a lot more of the higher risk pools. The beauty of this is that now the family members in the senior generation, instead of owning the assets outright on their balance sheet, they own partnership or LLC interests. And still today, we can use those partnerships, and if in fact people haven't yet used all of their lifetime exemption for estate tax purposes and gifted, and I highly recommend that if you haven't done it, you should do it, or at least consider doing it, because the exemption, which was targeted last year, which we thought was going to go away last year, and then when we got no tax bill by the end of last calendar year, the law of the land still is today that a married couple can give away some $23 million during life. That's the lifetime exemption. But it's much better to give away a partnership interest or an LLC interest or an interest in a closely held business, because still today, the law of the land is if you're giving a piece of equity that has lack of marketability and lack of control, you can take a discount for transferring that interest to the next generation in trust, typically in trust. So this structure, by design, creates for the senior generation to own partnership or LLC interest versus owning assets directly on their own balance sheet.
So, Allan?
Yes.
Allan, yeah. So I'm gonna bring us back to kind of 30,000 foot level for a second, because I suspect that there are some single family offices on the phone here on this webinar.
Yes.
And I'm going to ask you a scenario. So we know that most single family offices wrestle with deductibility of those family office costs, right? Because as you pointed out earlier with the Higgins case, most of those managing your own money is not deductible.
Correct.
So I'm a single family office. Let's say I have $500 million in assets. I'm an S Corp. I have only managed my own family's money, so there's no outside money. Would the for-profit family office model work for me?
The answer is it sure can, or it sure could, if oftentimes in a family like that, there may be a next generation family member coming in to the office, coming into the family, and they may be trained in finance. They may have gone to school. They may have a job in financial services industry, or they may have been trained in college in financial services. And yes, you can restructure that family office. Again, it could be a cost sharing family. I mean, you typically, it wouldn't, you said S Corp. So normally if somebody has an S Corp, they've got some sort of operating company in there. and we see this. I mean, I've several experiences over the last couple of years where a family will be running their business through an S corp structure, an LLC structure, and they have people on the team that work for them that are also managing the family's investments. And whether they're doing them direct, oftentimes in that structure, they're not even in pools of capital. Each, depending on how many family members are part of the family operating company, those employees inside of the operating company might be, again, spending part of their time doing work to manage the individual investments of the family members. If the government looks at that, if the IRS comes in, well, they're going to make that same argument that Higgins lost on, which is to say, they're going to say, well, some percentage of these people's time and some of these expenses that are being incurred, these are not ordinary and necessary business expenses of the operating company. Therefore, we're going to tell you they're not deductible. So in those situations, what we do is we'll typically drop down a LLC subsidiary under that operating company and create the for-profit structure with a separate entity that will then manage the assets for profit. If they don't have that structure, it's certainly possible and potential to reorganize and basically create a structure for profit. And oftentimes again, depending on the particular family, there may be family members or there may be key employees who will tie their compensation and their effort to the results of the profitability of the office through the for-profit structure. So it's that was a long-winded answer, but very possible.
So you don't have to be a C Corp. You don't have to have outside individuals that are not family members. You can still make this for-profit structure work.
You absolutely can.
Okay.
We might drop a subsidiary down. We might make a C Corp again. We might there's absolutely an opportunity there.
Okay. All right. Excellent. Appreciate that.
Do we have any other questions come up from the?
Not so far.
Okay. So I'm going to turn my attention to this case, lender management. And this is, I covered this a little bit, but we don't at Pathstone, I certainly in a venue like this don't talk, we're in the confidentiality and privacy business and don't talk about who our clients are. But in this particular case, I'm happy to say that the lender family is our client, was our client through this process and continues to be our client today, because if you actually go read Lender Management versus Commissioner, you'll see it was listed that Pathstone was an advisor to the family. So it's in the public record. I'll also say a little tongue in cheek that Keith Lender, who's next generation leader of the lender family office, he and I have done a few joint sessions like this together in talking about the for-profit family office. And I'll quote Keith and say, he often thought he was going to be famous, but it was as a baseball player, not because of a tax court case. So I'm sure some of you are chuckling right now and I can't hear you. In any event, lender management, as I said, the original reason that that Marvin Lender went looking for a structure like this had nothing to do with taxes. It was all about this, going back to this structure here, where basically he had one partnership for the entirety of the family. There were 27 distinct customers, and they were all in one big pool of capital. And so again, Marvin wanted to be able to asset allocate. He wanted his grandchildren's trusts to be able to have a much riskier asset allocation than he had. And so he needed to create multiple pools of capital. He was advised through the structure and through his employees and the effort that was going on there that a for-profit structure would be appropriate. The government looked at had previously looked at lender management a couple times before and signed off on it. And this third time, you know, it was a point in time, and the agent got a hold of it and saw lender management name on the management company, saw lender family members as customers or as clients, investors, saw lender, the lender name was just everywhere, you know. And so, I mean, one of the things we do these days when we form new for-profit family office structures, we typically pick a name that doesn't have the family's name in it. Just, you will never, if you do a word, so if you had the Internal Revenue Code, Title 26 of the US Code is the Internal Revenue Code. If you had it on your computer and you did a word search on the entire body of the Internal Revenue Code, and you typed in the word optics, you would get 0 hits. The word optics does not exist in the Internal Revenue Code. However, optics does matter. And so we encourage folks not to use family names when they're setting up for-profit family offices. But that was the case here. And the agent really took the position that this is even, and going back to this proportionality issue, ownership of the family office versus ownership of the assets. Well, at the time of the years of the audit, the first year of the audit, there was 3 years that were under audit here. The first year of the audit, Marvin Lender owned 99% of the family office. If you looked through the entirety of the assets that were being managed to attribute how much of those assets were actually owned by Marvin Lender, it was 15%. In the second or third year of the in question, through some wealth transfer planning and other, there was a transition where Keith Lender, Marvin Lender's son, took over the office and took over the ownership of the office. When you looked at this proportionality issue, Keith Lender owned about 6% of the assets were being managed. So the government's Higgins argument fell flat just from that standpoint alone, because to say that lender management, which was owned almost 100% by Marvin Lender initially, but it was only 15% of his assets. I mean, let's face it, in the real world, when we go invest with an investment manager, what do we want to see that investment manager have? We want to see they have skin in the game. We want to see they have some of their own assets at risk. Why do I want to invest with you if you're not willing to take some of the risk of your own strategy? So we always thought the government had a bad argument to begin with. And basically their argument was, and lender management in the years in question was a limited liability company. So in essence, all of the activity of the office, and it was a limited liability, an LLC taxed as a partnership. So all of the results of the office ended up on a K-1 that ended up on Marvin's personal tax return. So the government's position was to say all of lender management's expenses were non-deductible as ordinary and necessary business expenses. They were 212 expenses, and they needed to, in essence, be passed up to Marvin on his 1040, ergo not deductible because of the AMT. We fought it through the audit. We fought it through appeals. We tried to get some reasonable people in the IRS to see what we saw and what we believed. And ultimately, we found ourselves in tax court. That was the last place we really wanted to be. And we really wanted, the tax court strategy was really to try to settle the case. The government wouldn't settle, and in the end, basically in looking at the structure and looking at the carry and looking at all of the disparate customers and all of the activity that was in the office, in December 13th of 2017, the government held for the lender family. So I like to say, and gosh, I've been talking for, it's 10 till the hour. I'm having so much fun. I hope you guys are too. I'll just say this and kind of conclude here and then open it up for any Q&A that we might have. often say that the decision in lender management is good news and bad news. The good news is we won. And it's good for the lender family, and it was good for others who had this structure in place. The bad news is somewhat we won. And what is that? What do I mean by that? Well, because of the case coming out when it did, in December the 13th, because less than 2 weeks later, the Trump administration got the Tax Act. President Trump signed the act, and Section 212 expenses were no longer deductible under the act. These two things, all of a sudden, there was just a ton of activity of folks looking at the loss of 212 and the lender management case. And I would say in the professional community that I live in, there was a lot of folks that basically were advising their clients or potential clients to say, well, you don't have the lender facts, so you can't do a for-profit office, management, for-profit family office. And I would say that's categorically just not correct, because the lender management is a set of facts. It was a very good set of facts. But when taxpayers think about this, when families think about setting up a for-profit family office, we talk about it. We talk about a risk continuum. We talk about, lender, we couldn't understand why the government took it as far as they did, and why, we found ourselves in tax court. But you don't have to have all of the lender facts to have a for-profit family office. You can have less customers. You can have less pools of capital. What you need is a legitimate for-profit, profit-seeking motive, and you need the right structure. And it's a risk continuum. You may have a family that just hasn't been around as long. They don't have as many generations. You may have, you may have you might have an operating family business that wants to manage pools of capital in a for-profit manner that doesn't look like lender. So I'll just conclude here and open it up for questions by saying, it's a risk continuum. If you're interested in this type structure, if you don't, if you look at lender and you don't have all the exact lender facts, it doesn't mean you can't consider this structure. It's been my pleasure, Pat.
Yeah, so I have a question. So I know that you have an opportunity to look at a lot of different scenarios of family offices that want to become a for-profit family office. How often when you do that, do you find that you can actually accomplish changing to a for-profit family office from a typical family office structure? And second part of that question is, does having a family business as part of that organization help, or does it matter?
The amount of times that we meet with families that are thinking about this, that I would say 25 to 40% of the time there's a real opportunity there. And really it's based on the desire of the family to, again, this is a real activity. There has to be real busyness here. There has to be real things going on. There has to be a profit-seeking motive. So, I definitely think, again, depending on where a family sits and who in the family is interested in the family office, who's involved, oftentimes it's a great way. And we can have key employees in the ownership structure of the family office. It's a great tool to create incentives for key employees, not just family members, and key employees can be part of it. To your second part of the question, Pat, I'll use a real life example. So a client of ours, family, over $300-400 million of family net worth, 2 branches of a family, 3 generations deep, very similar to lender. But the family created their wealth in the real estate industry, buying and managing real estate. And that goes back some 40 years ago to when they started. Well, when the next generation of the family came into leadership, and they had a real estate management company that was the family business. When the next generation of the family came, a particular family member 15 or so years ago came into the office to be the next generation leadership of the office, this particular individual was not as excited about real estate as they were about financial assets. And so over this ensuing 15 years, the family member really, directed a liquidation of some $200 to $300 million of real estate and converted it into financial assets. And they already had multiple partnerships because they had already sort of seen the light and the benefit of having partnerships or LLC structures and having, again, 3 generations, 2 branches of the family investing in these structures. But what they had forgotten to do is the family office, prior to when it was a real estate management company, it was a business, and they had income and they covered their expenses, and they had, third party, they had non-family member employees. But as they converted to more financial assets, the family office had less and less income because they weren't taking any fees like they used to take from the real estate. And they weren't taking any fees from the financial assets because the fees were all being incurred at the partnership level and being non-deductible. And so we came in and said, there's this great opportunity here to basically continue to use your family office real estate management company, but to recognize what you're actually been doing is you're also managing these pools of capital. You just haven't been getting compensated for it. And so we layered in a for-profit structure.
Oh, we just have a couple, thank you for that. We just have a couple of minutes left. And Lorna's asked this question. I don't know if you can answer it in the time that we have left, but Lorna, I'm going to connect you to Allan by email, because I think this is a question that he needs more details on in order for him to truly give you an answer in less than a minute or so. So this is the question. We are currently.
I've got it on my screen. I've got it. We are currently an S Corp.
Yeah.
Okay.
Yeah.
So
Lorna,
this is
an asset manager.
Yeah. So in the short answer, Lorna, if you're an S Corp and you have multiple LLCs and you're charging an asset management fee to those LLCs to the S Corp, then those LLCs are paying that fee, and that fee is probably being considered, again, I don't know your particular facts, probably being considered a Section 212 expense at the LLC level. And when your tax preparer is preparing the tax return for those LLCs that are being managed by the S Corp, they're probably being passed out as non-deductible expenses to the owners, to the investors of the LLCs. So a restructuring for you could potentially be quite valuable. And I'll just close by saying, remember, the investors win not because they get to deduct what they couldn't otherwise deduct. The investors win because the first slice of income to be allocated from the partnerships that they're investors in gets allocated away from them to the family office in respect of the carry. So then there's less income being allocated to the investors. And by having less income allocated to you, it's just as good as getting the tax deduction.
Okay. All right. Well, thanks, Allan. I really appreciate it. I think it was a great webinar. You gave us a lot of information to think about. I appreciate everybody being on the call today. Wish you well. And once again, Allan, thanks so much for your presentation.
It was really my pleasure. Enjoyed it. Thank you so much.
You're very welcome. Take care, everyone.